Have you ever thought about making your money work harder for you, but felt overwhelmed by all the investing options out there? Well, probably the easiest way to do it is through investing in index funds, and it's a popular choice for both beginners and seasoned investors alike. Now, you might be wondering, what's so special about index funds? Well, they're a powerhouse when it comes to building wealth over time. In fact, the average annual return on major index funds can be around 7% to 10%. That means, by investing in index funds, you're setting yourself up to grow your savings steadily, without the hassle of picking individual stocks. The beauty of index funds is that they are accessible and beneficial for just about anyone. Whether you're saving for a new home, planning for retirement, or just trying to make your savings grow, index funds can be a fantastic tool in your financial toolkit. And if you're scratching your head, wondering, how do I get started? Don't worry. We're here to walk you through everything you need to know about investing in index funds, step by step. Whether you're a beginner or you've been investing for years, there's something in this video for you. And if you're new to our channel, hit that subscribe button and ring the bell icon. That way, you won't miss out on any of the valuable insights we're going to share in our future videos. All right, let's jump right into the first step to invest in index funds for beginners. Have a goal for your index funds. Now, before you set out on any journey, you need to know where you're going, right? Investing is no different. Understanding what you want your money to achieve will guide all your investment decisions. If you're aiming to build a fortune quickly, and you're okay with the ups and downs, then high-risk options like individual stocks or cryptocurrencies might catch your eye. These can offer big payoffs, but remember, they come with big risks. However, if you're in for the long haul, like saving for a cozy retirement, or maybe funding a future dream, then index funds are your best friend. They're designed to grow steadily over time, mirroring the performance of a broader market index. This means less worry about picking the right stocks and more time enjoying life while your money works for you. So, take a moment to think about what you really want from your investments. This will not only help you stay focused, but also make it easier to handle the normal rises and falls of the market without panicking. Now that you've set a goal for your investments, next you have to choose the right index funds. This step is all about doing your research and understanding the various types of index funds out there. So, what exactly is an index fund? Simply put, it's a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific index, like the S&P 500 or the Nasdaq. By investing in an index fund, you're essentially buying a little piece of each company within that index, which can be a simple and effective way to diversify your portfolio. When it comes to picking the right index fund, there are a few key factors you should consider. First off, think about the company size and capitalization. Index funds can focus on small, medium-sized, or large companies, known as small cap, mid cap, or large cap indexes. Each of these has its own set of risks and potential rewards, so you'll want to choose one that matches your investment goals and risk tolerance. Next, consider geography. Some index funds focus solely on companies traded on US exchanges, while others invest in international markets, providing exposure to economies around the world. This can be an excellent way to spread your investment risk across different markets and economies. Then there's the business sector or industry. Maybe you're interested in technology, or perhaps consumer goods or healthcare. There are index funds that specialize in specific industries, allowing you to invest in areas you believe will grow over time or that align with your interests and values. You should also think about the type of assets the fund tracks. Beyond just stocks, some index funds track bonds, commodities, or even cash equivalents. This can further diversify your investment and protect it against volatility in the stock market. And let's not forget about market opportunities. Some funds are designed to tap into emerging markets, or specific sectors that are expected to outperform in the future. These can offer higher growth potential, but often come with higher risks. Warren Buffett, one of the greatest investors of all time, has famously said that most people would do just fine by investing in a broad market index fund. This kind of fund offers a well-rounded snapshot of the market, providing good diversification across various sectors and company sizes. However, if you have specific interests or goals, like increasing your exposure to emerging markets or investing more heavily in technology, you can tailor your portfolio by choosing specialized funds. By taking the time to research and understand the different index funds available, you'll be well equipped to make informed decisions that align with your financial goals. Alright, you've done your research and you know what kind of index funds are out there. Now it's time to pick the specific index funds you want to buy. When we talk about index funds, one of their biggest advantages is low costs. These funds are generally cheaper to manage compared to actively managed funds because they're not about picking and choosing stocks. Instead, they simply track an index like the S&P 500, automatically updating to reflect changes in the index. This automation makes them less costly to operate. However, it's important to note that not all index funds are created equal when it comes to costs. Even though they're generally affordable, they still have administrative costs. These are fees for the management of the fund, and they come out of your investment returns. These costs are expressed as a percentage of your investment in the fund. This is where you need to pay close attention. Even a small difference in fees can have a big impact over time. For example, two index funds might both aim to track the S&P 500, but one might charge 0.1% in fees, while the other charges 0.5%. That might not seem like a lot now, but over the years, that additional 0.4% can really eat into your returns. The bigger the fee, the more it can diminish what you earn, especially when you compound those costs over many years. Typically, the larger the fund, the lower the fees tend to be. This is because larger funds can spread their administrative costs over a larger amount of assets, which reduces the cost for each investor. So, how do you choose the right fund for you? Start by comparing the fees among the funds that meet your investment goals. Look for transparent information about costs, and make sure you understand how those costs will affect your potential returns. Now that you've decided which index funds match your investment goals and have a good understanding of fees, the next step is to figure out where to buy. You can purchase index funds through a mutual fund company or a brokerage, and the same options apply if you're interested in exchange-traded funds, or ETFs, which are similar to mutual funds, but trade like stocks throughout the trading day. When choosing where to buy your index funds, there are several factors you should consider. First, think about the selection of funds available. Some large mutual fund companies offer funds from various families, including some from their competitors, though the range might be narrower compared to what you'd find at a discount brokerage. So, if you're looking for a wide variety of index funds, a brokerage might offer more options. Another important factor is convenience. If your investment needs are straightforward, perhaps focused just on mutual funds or a mix of funds and stocks, a mutual fund company might serve all your needs from one platform. However, if you're also interested in more sophisticated stock research and screening tools, a discount broker could be more up your alley. Trading costs also play a crucial role. Unlike stocks or ETFs, which often have lower trading fees, buying or selling mutual funds can be more expensive, sometimes around $20 or more per transaction. So if the commission or transaction fee isn't waived, it's worth considering how much each option will cost you. Then there's the angle of impact investing. If you want your investments to contribute positively to the world, beyond just financial returns, look for funds that focus on environmental or social justice causes. More and more providers are offering options that help you invest in line with your personal values. Lastly, check if there are commission-free options available. Many providers offer no transaction fee mutual funds and commission-free ETFs. These options can significantly reduce your costs over time, improving your overall investment returns. Now, next important thing is how to actually make the purchase. First things first, you'll need an investment account to start buying shares of an index fund. This could be a brokerage account, an individual retirement account, IRA, or a Roth IRA. Each of these accounts will allow you to buy and hold investments like index funds. Once your account is set up and funded, you're ready to buy the fund. When making the purchase, you might have the option to invest a fixed dollar amount or choose to buy a specific number of shares. The choice you make here can depend on the share price of the index fund and how much you're looking to invest. For example, if you decide to invest $1,000 and the index fund you are interested in is priced at $100 per share, you'd be able to buy 10 shares. It's important to think about your budget and how it aligns with the fund prices. Investing a fixed amount can be a straightforward approach, especially if you're just starting out. This method, often referred to as dollar cost averaging, involves investing a fixed amount at regular intervals regardless of the share price, which can help reduce the impact of volatility on your overall investment. So, get your account ready, decide how much you want to invest, and take the plunge into buying your chosen index funds. Step 6. Last step. Finally, you've taken the plunge and bought your index funds. But the journey doesn't stop there. Even though index funds are known for their simplicity and have been a favored investment choice for many Americans due to their diversity and strong returns, it's important to remember that passive management doesn't mean set it and forget it. Keeping an eye on your index funds is crucial to ensure they are performing as expected. Your index fund's main job is to mirror the performance of its underlying index. To see how well your fund is doing, you can check its returns on the mutual fund quote page, which compares the fund's performance over various time periods against its benchmark index. It's normal for the returns to not be exactly identical to the index because of the investment costs and taxes, but a significant lag, especially one that exceeds the expense ratio, could be a cause for concern. Over time, fees can add up, so if you notice that the cost of owning the index fund is growing, it might be time to reassess whether this particular fund still meets your needs. High fees can eat into your returns, diminishing the benefits of investing in index funds in the first place. And that wraps up our beginner's guide to investing in index funds. We've covered everything from setting your investment goals to choosing the right funds, and how to keep track of your investments over time. If you found this video helpful, don't forget to subscribe to our channel and hit the bell icon. That way, you'll get notified every time we post new content. Thank you so much for watching, and we hope you feel more confident about diving into the world of index funds. Whether you're just starting out or looking to brush up on your investment knowledge, we're here to help. So, subscribe, keep learning, and start building a stronger financial future today.